Hello everybody, welcome to the BizNews Finance Friday webinar. Today we've got Dawn Ridler from Kerenga Wealth Management in Johannesburg, so welcome Dawn. And we've also got Deon Gouws, who's based in London, Credo Wealth and he's in a part of London where apparently the electricity isn't so good either, Deon.
The electricity is fine, but the internet feed is intermittent. It's a high density part of London, so I'm sharing my internet feed with the neighbors who are also at home.
Okay, and just for people who don't know who Deon Gouws is, you may remember that he wrote a best-selling book on match fixing in cricket in South Africa, but actually his main specialism isn't writing, even though he's a very talented writer. He's the Chief Investment Officer of Credo Wealth, and he has been the CEO of top asset management companies in South Africa, and he's got a string of degrees behind his name, and he has a huge amount of knowledge to share with us today on the global markets. And because he's South African, he obviously knows what South Africans are looking for. Deon, would you just like to elaborate a bit on how Credo Wealth works with its clients?
Thank you, Jackie. We're an independent wealth management business, although we do work with a number of partners on the ground in South Africa. We don't compete with anybody in South Africa, but we've got about 50 partners there. So we look exclusively after offshore money for South African clients, but also for international money for clients in the UK and elsewhere. We've got about 6,500 clients worldwide, of which by number more than half are actually in South Africa, and I presume some people on today's webinar will be from that client base. By value, it's a little bit less than half today, because we are growing quite nicely in London. We've got about 3.7 billion pounds of assets under administration, and we invest asset classes, equities, fixed income, and external funds and ETFs. So that's what we do. We look after people's offshore money.
Okay, and are you finding that demand has been growing in recent years?
It has. We've been in the fortunate position that we've had slow but steady growth each year since I joined Credo, which is now 8.5 years ago. It hasn't spiked in the last year or two, I think partly because our natural client base, a lot of them have already taken the bulk of the money that they wanted to take offshore. They've done so. So the newer clients that we get are maybe smaller clients, and even though it's quite nice to have every new client, it doesn't necessarily move the dial that much. So yes, as I say, it's been a steady trickle for some time now.
Okay, and while we're waiting for people to start posting their questions, let's chat to Dawn briefly. Now, many of our webinar attendees are very familiar with Dawn. Dawn has often had articles published in our thought leadership section on BizNews, and people always put lots of interesting questions to Dawn. So Dawn, could you just sketch out for people who are coming to our webinar for the first time a bit about how you work when it comes to doing financial planning with your clients?
My approach is to be completely holistic. There are, one might consider, sort of the unsexy parts of financial planning, like life insurance and short-term insurance and medical aid and things like that, that perhaps aren't quite as haven't got quite as much kudos, but they are still an essential part of financial planning. So whenever I talk to my clients, I always take a holistic view. But at the end of the day, the primary focus is usually on investment, and more offshore investment as well.
Thank you. So I think we're going to start taking our first questions in a second. So let me see. The first question is from Vickers. How do I get my funds directly invested in NASDAQ or elsewhere directly? Dawn, would you like to kick off maybe with an answer on how you go offshore directly?
In my opinion and in my experience, the best thing to do is to actually physically take your money offshore. And you can do that relatively inexpensively by opening up an investment/retail account in a place, say, like Luxembourg or Switzerland. I prefer to use Switzerland for a whole number of reasons. And so, you don't have to be a billionaire to open up a Swiss bank account these days. Obviously, with something like UBS and that kind of thing, you do have to be a billionaire. But with the smaller Swiss banks, who are just as rigorous, you don't. So my preference is to physically take the money offshore rather than invest it here and do an asset swap. You know, the thing is that yes, you'll get the returns and all of that kind of thing, but quite frankly, I don't trust this government one bit to, you know, change rules when it comes to asset swap. And also then it has when, you know, it has the state duty implications in as much that you might have to bring all that money back. The asset swap money is actually really still here. You're just doing an asset swap offshore. So my preference when we're buying shares offshore is to actually physically get it offshore and invest it from there.
Thank you. Deon, do you have anything to add to that?
No, I totally agree with that. Obviously, we're a business that specializes in accounts like this. So Dawn might prefer Switzerland. You know, we are that kind of business that would welcome those kind of clients as well. Just to bear in mind that to get your money physically offshore, you need to go through the process. You need to get your SARS clearance and the like. So there's some additional admin involved, but I think ultimately it's admin that's very much worthwhile. And then if you find an offshore provider, whether it's Dawn's one in Switzerland, a company like ourselves, or some of the many others that are out there that compete with us, you know, you can then buy that platform. You can buy the Nasdaq. You can buy an ETF called QQQ. I know it's an odd abbreviation, but people in the room or, you know, watching today may have come across it. So you can buy the QQQ and you own the Nasdaq, you know, just like that. If you are that way inclined. I would just say that if you look at various platforms, I think the user friendliness and the ease of doing business, the ease of becoming a client in the first place, will differ across the board. Some are quite sticky when it comes to the know your client kind of steps that need to be taken, what you need to prove. Not everybody wants a South African client necessarily, because South Africa is seen as a high risk jurisdiction. So there may be many providers out there, but some will be easier to deal with than others.
That's very interesting, Deon. What do you mean they don't want South African investors? Don't they appreciate investments regardless of currency? Or what is the concern with South Africans?
It's not so much a business issue as such, Jackie. It's ultimately regulatory. So we all, as you know, financial service providers, are regulated by the local regulator, and therefore there's lots of compliance, there's lots of hoops one needs to jump through. And when it comes to people in different countries, all the various countries are essentially risk classified as low, medium, or high risk. Frankly, South Africa, most people are seen as a high risk source of funds, and therefore there's additional due diligence that needs to be done in order to take that client. And a lot of businesses will just not bother. They say, listen, we don't have the risk appetite, and therefore we only deal with low risk jurisdictions. So it's not so much, you know, not wanting the business, it's the additional compliance issues that one needs to deal with.
Thank you. Kavesh has a follow-up question for Dawn. He's interested in getting his money into Switzerland, and he says, how much money do you need to open an account in Switzerland? You said you don't have to necessarily be high net worth. Do you have an idea of what the minimum would be?
You know, $10,000 is a good start. Right. Obviously, when translated into South African rand, it starts to, you know, become a little bit more eye-watering, but it's certainly not, you know, up in the million rand arena still. So with $10,000, you can still do something, especially if, you know, if you're young and you've got the risk appetite, because obviously with that, you know, $10,000 is not going to buy you huge diversification. And that would be the major issue of having a small amount of offshore. So, you know, if you're young enough or you have the risk appetite, or if it's excess funds, often money that I'm taking offshore for my clients is excess funds. They've got money here, for example, they're retirees, they've got money here, and they've got money, more than enough money to live on for the rest of their lives, but they take the excess money offshore. And then the risk appetite with that excess money can be greater. And then something like, you know, having a bit of share concentration while you know, add to it at 10,000 maybe at a time. That is what happens. So, you know, $10,000 is not going to buy you, you know, the full diversification across the Nasdaq, you know. But then again, you can use ETFs, and that's probably the way to go to start off with. If you've got a small amount of money, rather than buying individual shares, you know, rather than buying the Teslas or the Apples or this kind of thing, is just to buy something like QQQ or one of the other ETFs, that there are myriad of them.
So James has a question on QQQ, and he says, I thought QQQ focused on shorting the S&P, etc. Deon, can you just briefly sketch out what QQQ is and then respond to James?
Yeah, maybe I need to go and Google search QQQ again, but in my mind, QQQ is the NASDAQ ETF. So it is essentially the market capitalization weighted index of NASDAQ shares. So today it'll be dominated by all big tech shares, the names that people can guess, the FANG stocks. And I guess Tesla is quite big in that as well these days. But it's not the S&P. It is the other exchange. It is the tech-heavy exchange, but it doesn't mean it's short the S&P alternative exchange.
Thank you. Ian wants to pick up again on the clearing your money out of South Africa, and he says, does the SARS clearance also apply to opening a foreign currency account of less than 1 million rand? Dawn?
You know, getting any money offshore has to have a certain amount of SARS clearance. The 10 million has a higher bar to clear and than the 1 million. But my recommendation, you know, having learned quite frankly the hard way, is to use a forex specialist, people who do this all the time rather than your bank. You know, the banks charge double fees that these forex specialists charge, and inevitably you have to do all the legwork. You have to get all the clearances and the you know, the SARS approval and the, you know, clearance through the Reserve Bank and that kind of thing, whereas a forex specialist will do it at half the price and get all those clearances, and they won't, you know, be able to do it quickly so that it doesn't expire. Because the problem is that if you do it yourself, you usually take longer, and you know, some of these do have an expiry date, especially when it comes to SARS clearance, has an expiry date. So my recommendation would be to use one of the forex specialists, who, what they usually do is they put it into a holding account here, often with Mercantile, where it can continue to get money market rates until such a time as your financial advisor or your asset manager says, okay, exchange rate is now good, move it. You often don't get that kind of nuanced service from a bank.
Thanks. Deon, do you have anything to add to that?
Yeah, I mean, I don't disagree with anything Dawn says, but I would maybe debate this with her slightly and ask the question if it's really worthwhile from her perspective to do that for smaller amounts. I mean, we've been talking about $10,000, you know, in the last 5 minutes. I myself, in the last few years, taken a little bit of money that I had left in South Africa out, and I found that the additional admin to go to one of these providers to essentially go through the whole know your client, you know, exercise with an additional provider. I'm really allergic to admin myself, etc. Is not necessarily worthwhile. If it's large amounts, if it's hundreds of thousands and maybe millions of dollars we're talking about, by all means, if you can get an extra 20 or 50 basis points out of it, you know, find a better provider with a sharper price. But I found that with my own bank in South Africa, for a more modest amount, yes, it's probably cost me a little bit more, but it saved me so much admin, it was worthwhile for me. So that's the one question I will ask.
Dawn, do you have an answer for that?
You know, to each his own. You know, obviously, Deon's got his own bank account already set up. And you know, with my clients, we kind of have a full service thing where we help them set up the Swiss bank account, and so that, you know, with all the FICA and everything else, and you know, for Switzerland, for example, the FICA has to be originals, so you get it all signed here, and then it has to be couriered to Switzerland. So there are, you know, bigger bars, but you know, fortunately, the institution we work with in Switzerland, you know, they don't like you so much if you come from Ghana or Nigeria, or you know, from some of the Middle Eastern countries, but they're quite happy to deal with South Africans. So it you know, if you've got a bank account already set up, then it's a simple process just to send out, if it's, you know, if it's less than $1 million. But you know, the trick is, you know, do you have that? And particularly with bigger amounts, when it comes to you know, R1 million, 2 million rand more, you don't want to send it all out in one fell sweep and the next day the rand depreciates, and you lose 10,000 of that. You know, the rand is one of the most volatile currencies in the world, and you have to have a little bit of a delicate touch when it comes to taking out particularly larger amounts. Look, $10,000 maybe not so much, but certainly the bigger accounts, you do need to have a little bit more finesse.
Thank you. And keep your questions coming. There are many questions. There's one more on offshore foreign currency accounts, and Oresti would like to know from Dawn is it not good to have a foreign currency account via a local bank?
No. I just haven't had great experiences with the offshore arms of local banks. So, in my opinion, no. But it's just my opinion.
That's a very firm no from Dawn. Let's move on to Deon. Cliff has a question. Can a South African resident invest directly into the Credo fund?
Into that?
Yes, and there's more than one way of doing it. As a South African based in South Africa with rands, there is a Credo Global Equity Feeder Fund, which is hosted on the BCI platform for us, Boutique Collective Investments. It's also on various other platforms in South Africa, including Glacier and Old Mutual and Momentum. So there is a way of rands, but getting offshore investment exposure. But to go back to what Dawn said right at the beginning, that investment has not effectively left the country. You're investing in the global equity fund in rands, but you're going to get your money back in rands one day. If you want to do so directly in hard currency, whether it's pounds or dollars, you would need to get the money physically out of the country, and you would need to get it onto an offshore platform. It's either our own or 10 alternatives, which I can sort of share separately. But there are various ways of doing it. So it depends on whether you want to do it directly offshore or whether you want to do it with rands in South Africa. Both are possible.
Deon, can you just clarify? We're getting quite a few questions coming through about what does Credo do? Do you have funds, or do you give advice to put people into other funds? And the second question we're getting here, do you have any vehicles that minimize tax implications?
So let me answer the second question first. I mean, all collectives ultimately have tax benefits because you can do your trading within that. When I say collectives, I mean unit trusts. We're not tax specialists as such, and we don't have a sort of a tax focus. We are wealth managers and ultimately fund managers as well. So to the extent that tax is part of the equation, we just embrace that. So we're not tax specialists as such, but unit trusts or mutual funds or collectives do have lots of tax benefits, including, by the way, the whole issue of CITES tax, which may have been discussed in this webinar before, and perhaps we can talk about it a little bit later today. But if you invest in our fund or other funds which are registered outside of the UK, then you can save yourself from the CITES tax issue, which I'm not going to elaborate on now, but if people want to discuss it, we can come back to it. So to answer the first question, which is what Credo do, or what we do at Credo, we essentially, in a nutshell, do both. So we have our own solutions in the form of mostly equity and fixed income products, both managed portfolios where the client owns his or her own share in Microsoft and Alibaba and whatever else we may be owning in his account with us, his or her account with us. And we also have funds, the global equity fund that I've just mentioned. So that's the one half of the business. And the other half of the business is we have multi-asset portfolios, which is essentially risk-rated solutions depending on the client, whether it's low, medium, or high risk, and where the external investments happen in the form of funds and ETFs from other providers. So we don't invest in our own funds there. So there we invest in cost-effective, efficient solutions, and we'll get exposure through a combination of funds and ETFs. So we do both. We do our own investments, direct investments in various forms, and we invest in combinations of other funds in our risk managed portfolios.
And Richard has a good question. How do you recommend avoiding US and UK inheritance tax? So in other words, is there a way you can avoid all these taxes? Deon, you're nodding. You seem to have some ideas on that.
I just want to jump in and by all means, I can probably learn from Dawn as well, but this is exactly the CITES tax issue which I referred to a minute ago. So if you as a South African citizen today open a portfolio with Credo or somewhere in Switzerland, I'm not sure about Switzerland, so let me not talk about Switzerland. If you open a portfolio with Credo and you with our onshore UK custodian and we buy, or you buy yourself a Microsoft or Alibaba share, as I mentioned before, if you pass away, then you will be caught by the UK inheritance tax laws because you've got UK registered assets in your name. You may never have been to the UK, but because you had investments that were domiciled here, you will pick up UK inheritance tax consequences. The same is true in the US. Now, there are some rebates, there are some discounts, so it needs to be a relatively substantial portfolio before it becomes a problem. I think the threshold in the UK is 325 or 350,000 pounds for UK registered assets. In the US, it's less. So you will pick up that problem. The way to avoid it is to still invest, via a provider like ourselves in the same jurisdiction, but where the underlying investment is not domiciled in the UK. So, for example, our own Credo Global Equity Fund is an Irish registered fund, and because it's not a UK registered asset, therefore, in that investment, you won't pick up the inheritance tax consequences as a South African investor. That is the CITES tax issue that I referred to before.
One of the reasons we use Switzerland is because of the for tax reasons and the inheritance tax reasons, because they're agnostic. They leave your tax up to where you are as a resident, and obviously you're not a Swiss resident, so basically it would be governed by the South African inheritance laws. But I mean, if you want to get around South African inheritance tax, then you look at completely different vehicles, different countries, and everything else. If you want to avoid South African or any estate duty, then you have to start talking about trusts and that. But at the end of the day, also setting up a trust later in life is often really not a very good idea, and they keep changing the laws around trusts, because look, no tax authority likes trusts because it keeps money away from them, so they keep changing the laws and changing the laws. I mean, trusts today compared to what they were even 10 years ago, they're much less advantageous, so they become much less of a tool to do tax planning, and the ones that do it, and through Malta and places like this kind of thing, you usually charge an arm and a leg.
Thank you. Now, most people have been interested in the FANG stocks, but Guy doesn't want to invest in them. And he says, is there an offshore international ETF with reduced exposure to the tech sector now for a tech-wary investor? Dawn or Deon, who would you like? Dawn?
I mean, Vanguard alone has got thousands, so you name your poison, there's an ETF available for it. Green, not green, with casinos, without casino, absolutely anything is available out there. It's just a matter of finding it.
Yeah.
I can't name one specifically, but I know that they will be there.
I mean, I'll just give one example. There are ETFs out there, and we invested in some of these ourselves, where you can buy, for example, an S&P ETF, but where the stocks are equally weighted. So just to give you an example, if you bought the S&P today, then the 5 largest stocks in the world, which is basically, it's not quite the FANGs, but it's pretty much the FANGs. Microsoft is in there, not Netflix. So it's the FANGs, but with an M, not with an N, essentially. Those 5 stocks today are worth about half of the S&P. So the other 495 stocks are worth half, and 5 stocks are worth half. If you buy an equally weighted version of the S&P, then you get Apple and Amazon and Google and Facebook and Microsoft at whatever that is, 0.2% each, not at 10% each within your ETF. So that's an example, an equally weighted ETF. There are many other examples. You can go to a value investor. We happen to be value quality investors ourselves, and it's a concept that hasn't had a good time for the last few months and years. But you can go to any value investor and you will very much get a lower weighting in those stocks as well. So that's not an ETF, that's an active position. It's a different element, but there are many alternatives.
Yeah, Deon, I hear the FANGs and I call FANG man. So the
Correct.
Microsoft is in there.
Correct, and then you can retain your NVIDIA. You're dead right. And you've got all that as well. So it's the FANG itself it's really a FANG with a double A, isn't it? So it's Apple and Amazon.
Yes, but that's why they put FANG man, so that the double A goes into the man, I think.
Correct.
So Shamir wants to get into practical details of investing offshore again, and very interested in ETFs. And he says, for offshore investments in ETFs, would you recommend investing in lump sums or more frequently to ensure dollar cost averaging? So perhaps, Deon, if you could just explain what dollar cost averaging is for people who aren't familiar with it. And then secondly, lump sum or rand cost or dollar cost averaging?
Dollar cost averaging is a simple term which basically boils down to the fact that if you invest at regular intervals over a relatively long period of time, a similar amount, or if you can afford it, a growing amount, then you will get the benefit of the market growth in your favor, but you'll also get the benefit that when there's a dislocation from time to time, like we saw in March with, the COVID impact on the market and international markets falling, between 30 and 40% within a few weeks, then it means that if you have the discipline of continuing your dollar cost investing, that next tranche that goes in at the end of March goes in at what proves to be a wonderful time and a wonderful buying opportunity, even if at the time you didn't feel too positive about the market. So you're buying more at lower levels at the end of March, for example, and you'll be buying less at more expensive levels at the end of August. You just take this year. But the bottom line is you get those swings and roundabouts working in your favor because you're buying more at the good levels and less at the high levels. Keep on building your portfolio. So it's a very good way. It's a very good discipline that has very good results if you can keep on doing it for the longer term. To answer the question whether people should be doing it, I think yes. If you have the spare cash to do so, it does make sense. I will say this though, that if you let's say I want to go back to the $10,000 example that was mentioned before. In global investment terms, $10,000 is not a particularly substantial amount, and there's always costs involved with investing. And some of these come in the form of essentially fixed costs. It could be a service charge or a settlement charge or something. People call it different things. And to invest $10,000 once off versus investing $1,000 10 months in a row, you could find that those 10 times $1,000 investments cost a lot more to deploy than 1 times 10,000. So it depends on the amounts involved. So for a relatively small amount, anything under, I'd say, even $100,000, or certainly under $50,000, I think once off may just be the best way of doing it. But if you are lucky enough to inherit a couple of $100,000 today, and you're not sure what to do with it, you want to invest it offshore, or even locally, it's really the same principle, then my suggestion would be do it in tranches over a few months. And from a behavioral point of view, you win both ways. If the market goes up, you can say, listen, at least I got some money away at the cheap levels, and therefore I can benefit from a rising market. And if the market comes down, you win as well, because you can say, okay, I can get my next tranche in at a more attractive level. From a behavioral point of view, from an emotional point of view, you win both ways.
Thank you. Dawn, do you have anything to add to that?
My recommendation, if you want to sort of take advantage of dollar cost averaging, range cost averaging, whatever you want to call it, would be to use a feeder fund from here to do that. Because then you're not going to run into the cost problems. Because one of the issues that, for example, if you take $10,000 across or even $100,000 across and you put it in a bank account or a bank account there. Now, I mean, the bank accounts, like, for example, in Switzerland behave a little bit differently. You can have a retail and investment account all in one. So your money would go into that account, and it would be up to you to do that sort of, that rand, to sort of feed it into the market as when you think it is appropriate. Now, most of my clients, I work with an asset manager, and he and I work together and give the client advice in terms of what they should be buying and when they should be buying it. And they give us a mandate in order to do that, so that they don't have to log into their account and try and do the buying and that kind of thing. So I think for the average South African investor that has maybe 10,000 a month even to put into it, I'd say a feeder fund is probably a better idea. But find a feeder fund that isn't outrageously expensive, because there's some horribly expensive ones out there. Nasty.
And can you give an example?
I don't know about you, Deon, I'm sure you aren't, but you'll know who I mean.
Yeah, Dawn, I won't comment on that, but we only launched our feeder fund in February this year, and we're very much aware of that point. And in fact, if you go and crunch the numbers, or anybody out there that will look at the numbers, I think we'll find that we're at the low end of the scale. It is an important issue. So I'm glad you mentioned that.
How much more expensive is it to invest offshore than invest in South Africa, just in terms of the costs? Deon,
you mean feeder fund, or what are you referring to? The whole process?
But maybe you can be more specific. Funds, ETFs.
I think it depends. You know, there's so many elements to that answer. I mean, funds and ETFs offshore in general are cheaper than South African funds simply because there's more of them, much more competition, much more efficiency. But the point is you need to get the money there in the first place. So to get the money there involves certain costs. You know, there's a spread in the currency, which Dawn will minimize for you if you use a forex provider. There's a lot of costs, but I would say that the actual investment management cost, if I ignore a lot of the other frictional costs, is not more in offshore space than it is in South Africa. I think in many cases it's actually lower. But the point is the experience of a South African client to get the money offshore in the first place. So let me just mention one which hopefully makes total sense. If you invest in a feeder fund, including our own feeder fund, you know, there are additional costs because the feeder fund is housed in South Africa on the South African platform. There are local administrative and compliance requirements, you know, and unfortunately those things cost money. So an investment in the local feeder fund at Credo will cost you something like 1.2 or 1.3% today, whereas if you invested it directly with us, if the money is offshore already, that will be about 1%, under 1% in fact. And that additional, call it 30 basis points, 0.3%, is essentially the additional cost of the extra layer that is required to get the money out via the feeder structure and the subsequent administration and compliance and the like that I've mentioned.
Thank you. Dawn, whenever we see or hear about fees, we always hear very small numbers, 1%, 2%, 3%, but these can add up quite quickly, can't they? So how would we actually know when 1% is a good fee or 0.5%? At what stage do you need to be thinking carefully about these fees?
The quick and the easiest way to actually determine it from a quotation or something, or to ask your asset manager, financial advisor, whatever, is to get what's called an effective annual cost, an EAC. The effective annual cost will add because they are the platform fees, right? Then there's the fund fees, and then there might be the asset manager fees over and above that, and then financial advisory fees, and these all need to be added up. So if you just look at a fund fact sheet, all you're going to get is the costs directly associated with that fund. It won't give you those platform fees, it won't give you advisory fees, it won't give you, it won't be able, it's not allowed to give you performance fees because they change all the time. My preference is to use funds that are clean, that have no performance fees, for example. But when you start looking at effective annual costs, and I mean, people who read my stuff and listen to me frequently know that I will not use an insurance platform, for example, because if you do an effective annual cost with an insurance platform, you can find that those effective annual costs come out at somewhere in the region of about 5 or 6%, no problem. I mean, which, yeah, you raise your eyebrows, Deon, I kid you not. I can show you examples, you know. The first time I saw it, my jaw hit the table. So the best thing to do is to ask the provider for an effective annual cost, a breakdown of those fees, and then you add them up and you'll be able to see. And you know, a sort of 1% for an offshore fund is quite reasonable. You know, then but you know, advisory fees, if you've been given advice in terms of what funds to actually buy, what shares to buy, because I mean, a lot of my clients, for example, have bespoke portfolios rather than, you know, putting it into unit trusts. And then, you know, you obviously have an asset manager who gives the advice in order to do that. So the best go-to is to ask for an EAC or to find an EAC.
Thank you. Now, Marie Aurelie, I think you pronounce it like that, says she's under the age of 55, has a preservation fund and contributes to an RA. What amount can be taken out of either without paying tax? And if it is possible to withdraw a tax-free amount, would you suggest that the amount be taken out and invested offshore? Or should I take one tax hit, liquidate everything and invest offshore now? So quite a few parts to that question. Dawn, you want to take that one first?
Do you want me to answer it? Okay, yeah. Basically, the first question is she going to financially emigrate or not? Because without financially emigrating under the age of 55, you can't do anything with your RA. Okay, so that has to stay here. When it comes to preservers, obviously you can liquidate them, but the tax impact is heavy. You know, you're talking about, you know, I mean, there's lump sum tax tables which she's more than happy to speak to her privately about what those tax tables are. But they start at, you have a 22,500 tax-free amount, but after that it's taxed at 18%, 27%, 36%. So you could potentially lose more than 1/3 of the value of your fund, which would take you forever to get back that 30%. But once you've liquidated, then you can take that out, because it's now being taxed. It goes through SARS clearance, and you can take that out. The sort of more pertinent question is, once you get to the age of 55, should you leave it as an RA? Should you retire from it? Then you've got annuities, and then there's sort of tax implications should you want to financially immigrate in the future. And the other thing to take into account is that Tito did intimate that they are going to be looking at the whole regulations around financial immigration to make them easier. What that means, God knows. But it is a very sort of it's really in a lot of flux.
Thank you. And then Denise wants to know, are there options to transfer a current living annuity to an offshore living annuity? If so, what are the benefits? And Dawn, that sounds like your area.
Could you just repeat the question, Jackie?
Sure. The question is, are there options to transfer a current living annuity to an offshore living annuity? If so, what are the benefits?
No, I know people a lot. I get this question a lot, and no, there isn't. If you financially immigrate, and it's already in an annuity, in a compulsory annuity, you are going to be, it does become part of the sort of blocked RAND account. So the only way really that you can speed up getting it out is sort of to take the full 17.5%. Before that, and you want to take it out, and then there's the tax-free things. That's why I say to my clients, don't jump to retiring from your funds before really thinking it through really carefully, because once it's in an annuity, we do have double tax scenarios with the UK and a lot of countries around the world, but actually sort of taking it and transferring it to the UK and not taking a tax note, it doesn't really exist.
Okay, thank you. Another Deon wants to know, please give your quick assessment on cryptocurrencies. Are these good opportunities or just gambling?
How much time do I have, Jackie?
2 minutes.
Look, it's a bit of a controversial question, so I'll try and keep it to 2 minutes. I think the short answer is that you should go there unless you tick both of the following 2 boxes. One is with a fairly small piece of your portfolio, maybe 1% or so, or maybe less. And secondly, do your research and make sure that you have an understanding of what you're investing in. I'm not one of those people who says a blanket no. I do think for some people there's a space to, for some exposure. But the bottom line is these things are volatile. They're not well understood. And there certainly were a few years ago, lots of fly-by-nights out there in terms of alternative cryptos. So yes, I think there is an argument if you know what you're doing and if you don't overexpose yourself. I'm not one of the people that says all of it is a heresy and a bubble. But I think you need to tread very carefully if you're going to have any exposure in this regard. Just to mention that I myself own a little bit of Bitcoin. I own less than 1 Bitcoin myself. I bought it a few years ago, essentially as a bit of a, call it a lottery ticket effect, thinking that, if it keeps on going nicely, it'll be nice to participate. But frankly, it's the amount of money that if it goes to zero is not going to hurt me that much. And if you can say that about your cryptocurrency investment, by all means, go with go and expose yourself to it. But I certainly wouldn't overexpose myself to it at all.
Thank you. And then Dawn.
Yep.
Sure. Sorry, it looks like we've lost Jackie. Let me just see. Jax, you still there? Okay, I'm just going to pick up where he was. Sorry about that, guys. Dawn. Dawn, there's a dog in the background as well. Dawn, there's a question here from Avishka Gordon. She says, or he says, I noted in an interview on the 9th of August, you said buying physical gold is not the way to go. Can you comment? I don't know if you've got anything on the gold story as well, Deon.
Sorry, Stu, I didn't hear that. I've got competition from my menagerie downstairs.
Oh, okay, no problem. It's just your feelings on gold from Avishka. It says buying physical gold is not the way to go, something you noted on the 9th of August interview. I don't know if your feelings have changed around the yellow metal.
Yeah, I think gold had its, had its time at the moment. I think there are other commodities, if you want to call gold a commodity, which is debatable, that are probably more interesting than gold right now. Those other commodities, as demand picks up again in the various economies around the world, and there is a lot of money going into infrastructure, or talk about a lot of money going into infrastructure all over the globe in order to boost economies and really to put people into work. So gold is more of a kind of a hedge, and it certainly played a role over sort of a 2.5 month basis, and it's now sort of tapered off. Our clients' portfolios are more sort of weighted more to some of the other commodities other than gold at this point in time.
Thanks, Donald. Go ahead, yeah. So your thoughts?
No, I just want to say, I mean, I think gold is a little bit like crypto, actually. It's a religion, and you get people in different churches. You get those that love it and those who don't. I happen to be of the religion that doesn't particularly like gold, and I've been in that church since 1998. Warren Buffett famously said that, gold gets dug out of the ground in Africa or someplace, and then we melt it down and we dig another hole, we bury it again and pay people to stand around guarding it. It has no utility, and anyone watching from Mars would be scratching their head. So I read that in 1998, and I haven't really worried about gold too much. And then more recently, Warren Buffett went and bought gold, and people are saying, this proves, he's changed his mind, it's time to buy gold. But to those people, I say his investment in Barry Gold a month ago was something like $500 million. Now, that may sound like a lot of money to people on the call, but that is 0.1% of Berkshire Hathaway's market capitalization. So it's 1,000th of the company. That's hardly a hedge for the rest of their portfolio. So yes, I think gold has had a good time. I think ultimately, like many things in investments, the price has driven the sentiment and the narrative. Will it keep on going? Time will tell. But Stanley Druckenmiller said, there are many shoes on the shelf. We're only the ones that fit, and the gold shoe doesn't fit me. So, if you're in that church, good luck to you, and you would have done well the last few months. But it's not something I would rush to buy today.
Excellent, thanks, Deon. I see Jackie's, unfortunately, her computer's crashed. She won't be able to come back, and I see that was the last question. I think it's probably a good time to end the webinar now. Thanks for your time there and your input. It's always appreciated. And to the attendees, we will post the video on the YouTube channel in the next hour or two, so you can catch up on any input that you might have missed. But thanks again, both, and I hope you have a lovely weekend.
Thank you.
Okay, right. Bye.
Bye-bye.